This is Jed Brewer with Study Groups and the Below the Line Club. Real excited to have you on the call here today as we discuss change at the pump. Two short presentations I hope you'll find to be a valuable use of your time. The first person we're going to have speak is Darren Domi, who's the managing partner of Powerline Group. And Darren's a commodity and risk energy futures trader. He's been involved in the commodity trading risk management business for 30 years. And he's been a risk management advisor to Midwest agricultural co-ops. Several of our study group members will use him for various hedging and risk management strategies, and generally helping out folks in the energy and commodity markets, both sellers of energy and commodities as well as users. And the second person we're going to have is Richard Brown, who's Vice President of Marketing at Patriot Capital, and he'll be sharing with us more about the changes in EMV as we've seen it now get that liability shift delayed over time. So let's go ahead and jump in with Darren. A few housekeeping things. I've got everybody on mute here today, but if you have questions, we certainly encourage you to ask any of them. What we'd appreciate you doing is just typing into the dialog box that you have in this GoToWebinar framework. I'll be able to see those questions, and I can try to relay them to our presenters as we go. So with that brief introduction stated, Darren, I'm going to turn the floor over to you and allow you to share with us a little bit about your 2017 fuel market forecast and what's going on with OPEC and other things in the petroleum market. I can see your screen.
Wonderful. Thanks for the introduction, Jed. Can everybody, you can see my screen fine, Jed?
I can.
Okay, wonderful. Just wanted to let everybody know that's you can put a picture with the voice. I just put my picture up there real quick so that everybody could see who's actually speaking to you today. Another thing I need to cover real quick is a disclaimer, because I do have a commodity brokerage license. I am governed by the CFTC, and I have to let everybody know that there's risk in loss in trading futures and options. So I can send this disclaimer back to anybody who'd like to see it after the presentation, and Jed will probably even forward this out after I PDF it. First slide today, of course, we've got a lot of great news to talk about. First is OPEC. Everybody's worried about whether OPEC is going to comply or not. Most of the news that we continue to hear today is that OPEC is running close to about an 80% compliance. Now, Bloomberg says something more like a 60, but depending on several of the other news sources that you look at, like Petrologistics and a few of the other Reuters news services, most of them are looking close to an 80% compliance rate. If you look down the latest...
Darren, Jed here, when you say 80% compliance, is it 80% of the countries are complying, or they're producing 80% of the committed volume?
They are producing 80% of the committed volume. In other words, they were promised to cut about 1.8 million barrels per day, and right now most of the talk is that by the end of January they were supposed to be about 80% of that 1.8 million barrels a day. Now, the chart to the right, you can see that this was by Bloomberg yesterday, and of course Bloomberg says that they're about 60% compliant at this time. They're trying to get down to just under we're cut at about 3.2 million barrels. So they're not quite there yet. They're still having a few problems with a few of the Indonesian and Asian countries. But right now, it's all signs seem to be pointing to the production cuts are going to continue to move on here as we go through the month of February. Even OPEC and Russia seem to be sparing Asia a little bit of their supply cuts and trying to make up for them, just so that Russia and OPEC don't lose any of their own market share in those Asian countries. Yesterday also, Reuters survey on Tuesday found Iraq lowered output by 200,000 barrels a day, and they're almost to the 210,000 barrel a day production cut number that they said they would do. Top chart here on the left in the pink, This is your crude oil production in the United States. You can see here's where we peaked out back in 2015 when oil prices peaked out, just over 9.5 million barrels a day. Dropped it all the way down to just under 8.5, and now we're back up pushing 8.9. We are bringing some oil back on. Most of it seems to be the shale, the fracking, as well as some of the, and I just lost the term I was looking for, but I'll come back to it. But here's something really interesting. You can see the production, how it's what we have lost of the 1 million barrels over the last year and a half. Here is our imports. The imports of crude oil continued to drop, but they bottomed out at the just about the exact same time that our production peaked out. And here our imports have gone from 7 million barrels a day back up to 8.3 million barrels a day. Seems kind of funny that when our production falls off, now we're back to importing the cheaper oil. So we were completely using this at one time, but now we're importing it. Here's something also very interesting. This chart over to the right with the red line, this is U.S. crude oil exports. And you can see that when they passed the law to approve the crude oil exports out of the United States in late second quarter, exports took off, and we go from basically next to nothing to about 550 to 700,000 barrels of crude oil a day. Now here is what is interesting. Okay, now I pointed this out that we started importing what we lost out of our own production, plus now we're exporting 550 to 600,000 barrels a day normally. Here is this export chart laid over the futures price chart. So this is crude oil in blue. Here's your $100 barrel. It's over here to the left. See my mouse? Okay, and then the production, or excuse me, the export number is over here to the right. All right, now notice this. Right here when we passed this law to allow exports, it was, I don't know if it's a coincidence or not, but look at the price of crude oil. It also goes right into its collapse. But while this chart is up here, I also wanted to point out the blue chart here is crude oil, and I wanted to point out that we have, from a technical analysis of price analysis, you have what's called an upside down head and shoulders. So this would be your left shoulder, here's your upside down head, and here would be a right shoulder. This is a very prominent bottoming formation, and it's over a long period here, over at least 2 years of 2015 and 2016. So it's a very broad-based, wide basing pattern, and the head and shoulders are very prominent, and you can Google them and see just how prominent they are in the tech trading world of stocks as well as commodities. But this one just happens to measure from $30 a barrel, and you can draw a neckline right here at $55 a barrel. And what this suggests is that in the next year and a half or so that we should be able to trade this market another $25 a barrel higher on top of the 55, which suggests somewhere down the road in the next year to 2 years we'll be trading back to $80 a barrel. And it's kind of interesting because old resistance, old highs become the resistance. So the market will eventually work its way back up towards this $80 barrel, but it's going to take some time to get that done.
So,
now,
Darren,
yes.
If I'm hearing you right, the technicals are suggesting that crude prices may be pushing higher. You said upwards as much as $80 a barrel over the next couple of years. Do you see the fundamentals as supporting that as well?
Not today. Today's fundamentals don't support it. But it's the funny thing about charts and technical analysis. They always have a tendency to tell you what's going on long in advance before you seem to get some of the news to hit the market, I should say. So today, things still don't look very bullish, but you really don't know what's going to happen down the road. And I've got a few interesting charts to bring up to you that I think you'll find of interest in a couple of more that may suggest potential for that higher crude oil value. But right now, I just thought I'd bring it up because crude oil prices are rallying. We still need this shale oil, the horizontal drilling, as well as the fracking. But what you're looking at today is the chart to the right shows you where all the investment is going. it's really not going into the Bakken field. You're only getting maybe 2% of the money that's being invested back into oil drilling here in the United States. Into shale drilling is all going into the Permian Basin in West Texas. What is interesting is all the money that's going out there is really pushing land values higher. And I read this yesterday, and I thought this was a really interesting statement. Demand for West Texas acreage has sent land prices soaring in the last 2 years. One deal in December 2016 priced out at more than $63,000 an acre. And I was reading a few other headlines yesterday on some of the, especially after Exxon reported their earnings, I was reading a few other reports on how many companies owned land out in West Texas and just how much money they were making selling that land today. Since Trump became president, everybody feels that we're going to go back to becoming energy self-efficient, and you'll see more oil drilling and shale drilling out through Dakotas, Texas, as well as back into this New York and Pennsylvania area, into Ohio. I also like to point out, yes.
You're a farmer. Give me a feel for what the fundamental value, absent the oil rights, would be for that acreage. You're saying it's one deal went for $63,000 an acre. What?
I'm not very familiar with West Texas land values out there, but I'm sure they're probably anywhere from several $100s an acre to maybe $1,500 an acre, depending on what they're able to irrigate and grow in that area. I know a lot of it takes a lot of acres to run a cow on out there, but if it's got the oil under it, this is what's making it bring the value, the oil and the natural gas. And everybody's trying to buy up those leases. And it's my understanding that some of those companies that bought up a lot of this land leases back in 2008 and 2009 are able to sell them out 4 and 5 times of what they paid for them just back then. They're actually making more reselling the land leases than what they are going out and drilling for oil right now. So you can tell there's an awful lot of investment willing to bet on the come here in the oil field. To move on, just so you can see, money managers, because the bond market has peaked out and is headed back down, U.S. Treasuries are headed back down, the bond market is losing money. So you're seeing a lot of money coming out of the bonds, heading back into the commodities. They look for commodities that they feel are undervalued or have sold off hard in the last year or two. It increases the odds for a bounce, even a correction bounce in a bear market. So you're seeing these hedge funds come back in here, and even since the beginning of the 2016, when we made this low, you can see how they've really just continued to pour money into this crude oil market. And since the OPEC production cut going into that November time frame, you can see they've pushed this market up here, and they now have a record long position. That doesn't necessarily mean that it's a peak, but I think what it does suggest is that they're willing to bet that crude has the ability to continue to go higher. Another wild card here that could suggest that $75 to $80 oil is Iran. Of course, they've been shooting missiles off. Of course, the Trump administration slapped more sanctions on them, official sanctions today. That's helped to support the crude oil market. And then, of course, you heard Iran's coming back, and 3 days ago, rebels that are supported by Iran, Yemen rebels, attacked a boat, and it turned out to be a Saudi frigate, and they thought it was a U.S. ship, the way they were cheering and going on about it. So the Pentagon is on high alert, and of course, we all know how Trump seems to be. He's going to be very proactive, and he's already putting sanctions back on Iran, and I think you're going to have to worry about a risk premium coming back into the crude oil market. So this is a big reason here. I don't think Iran's willing to back down, because they never did to Obama, and they would come within feet of our own ships. And if they keep that approach up, Trump's going to cause a big flare-up, probably back between Iran and the U.S. in that area. One other thing that I find very interesting in the crude oil, this is a little report by Citibank yesterday, the research department. They feel that there's a soft ceiling in the crude at 65. Soft meaning they feel that there's pretty good potential to go through this 65, while rounds of OPEC versus Shell market share battles could push us back to 40. But it all depends on how the Shell oil acts. As it is right now, you couldn't hire a Shell, an oil drilling rig to get out to your property for probably 5 to 6 months. A lot of them shut down. You just can't even get them hired because they're all, what was left is all out, back out drilling. And it's going to take anywhere from 6 to 8 months or 6 to 12 months to complete those wells and then start moving that oil to town. So eventually it's going to come back, and again, a Shell oil well or horizontal drilling well has a very quick production life. Instead of producing 10 to 30 barrels a day, they can produce hundreds, if not close to 1,000 barrels a day at times. But what I really wanted to impress upon you on this chart, you can see my mouse moving over here to the right. This is global oil supply disruptions. And as you can see, since 2013, we would normally have about 3.5 million barrels of production risk all through most of 2013, 14, and about 3 million barrels a day of risk through 2015. All of a sudden, this risk in 2016 is very low, meaning Libya doesn't seem to be having any problems. Nigeria doesn't seem to be having any problems. Iraq doesn't seem to be having any problems, and neither does Iran. So what we feel is when you get down to this low, you have a much bigger upside risk in some sort of oil field disruption, or rebels in Nigeria or Libya, and then again we feel that there's going to be some potential issues with Iran as we move down the road. One other wild card that I feel that's got a lot of potential going into the end of this year, or maybe even later this summer, hurricanes. We have not had a hurricane hit major landfall in 11 and a half years now. And of course the last one was Hurricane Wilma back in 2005. So, you know, the odds are increasing. So I think you have to be very careful about being short product as you get into summer. And the hurricane season officially starts usually in June, and it'll run through October. So if we can get to October 1st or towards the middle of September and the 10 to 20 day forecast, it really isn't showing any hurricanes on the horizon, then I think you can relax and start easing up on some of your long positions in your storage. What I also wanted to point out is, Jed, you asked me why I also am bullish on the crude oil market. This is every bar represents 3 days, and this is a crude oil chart. And from a technician standpoint, when I look at this chart, I see what's called a bull flag. Here is my flagpole coming up. It goes from 47 up to 56. And this is my flag area. And technicians can measure the distance of the flagpole from 47 to 56. That's $9. And I continue to hold a very nice basing pattern at 52. Now what happens is normally 70 to 75% of the time you'll follow through with this pattern, and what is happening is that when the market took off from November 15th and ran higher, all your trading congestion has gathered up in the top 25% of the trading range. So the market's resting up here, which suggests that this pattern will continue, and when you get your close back over 55 and you have a breakout, close over 56, it'll measure $9 higher up to around to that $65 per barrel area. So I do have several measurements that measure up to 64 to 65. Just to give you an idea, if we do go to 65 and I continue on with a $20 a barrel crack spread on summer gasoline, that's $85 a barrel gasoline. So that suggests that at 85, that 85, that suggests $2.02 to $2.05 on the April through August futures on gasoline. All right, now we are switching to gasoline. Hey Jed, any questions on crude before I switch over? Okay.
My big takeaways, I mean, I don't have specific questions, but what I heard you say is it looks like from the technical analysis, the prices may be moving higher. You said as much as $75 to $80. It appears
over the next year or two. Yeah, I see us going up towards 65, Jed, potential here this spring and summer.
Okay.
But I think to see the 75 to 80, it may take something a little bigger to get us up there. Yet I don't know what that is at this time.
And it could be a supply disruption that you had mentioned has been relatively minimal recently compared to history.
And that's what I think it's going to be. It's going to be a supply disruption. We just have very little oil at this time, off the market, and I think you'll have something flare up in either Nigeria, Libya, or Iran that'll end up pushing the market back up. And
the question I would have is, prices move higher. You showed prices have already moved a little bit higher in 2016, off of the lows and the head and shoulders. There's your graph, that head and shoulders one. Would more U.S. production come online as prices move higher, thereby, dampering some of that price increase effect?
It can, but here's what's interesting. When you talk to some of the other oil analysts out there, you have to also take into account, why is the market already trading or hovering between 52 and 56 at this time for the last 2 months when we know it's going to bring more oil on, right? Evidently, the market can seem to handle it at this time. Now, it's always the job of the futures market to react in the future. Usually it's a little bit ahead of all the news that you seem to be receiving. So when we look at this thing, obviously there's shale oil production that's going into place, but it's not all going to hit the market at once. It's going to take a while to get it to come back into hitting the street, I should say. And that may be towards the late third quarter, fourth quarter, or towards the end of the year when you start to see a bigger chunk of crude oil, U.S. shale production hitting the U.S. And that'll be, in my opinion, when we'll be putting in our seasonal high, probably in that August-September time frame. Then you'll get a correction back down into the winter, and you'll start seeing production slow down, and OPEC will probably maybe even discuss another round of cuts, or you're going to continue with economic growth. So we'll have to see what happens. As it is right now, the best, if we did fall apart, I only see us coming maybe back down to $40 a barrel. Gasoline. Everybody's been talking about the gasoline demand lately, and this red chart is gasoline demand. And you can see here's where we were into the summer months, and the demand numbers are over here to the left. So we got up close to 9.8 million barrels a day for a peak this summer, with just over 9.7. And then today, early this week, we were at 8.3 million barrels a day, 8.310. And then the week before, we went down to just over 8 million barrels a day. This just happens to be the gasoline futures chart laid over the demand chart, but there's really not a whole lot here to look at in terms of fluctuating demand versus the price. But it is also interesting, is everybody's making a big deal out of this big 7.7 or percent drop that you saw on the DOE report in demand 2 weeks ago when we were down to 8 million barrels. From a trader's standpoint, this is nothing that we don't see every year. Last year, during the month of January, we were down 7.5%. But February comes back, and you can see demand starts heading back up. And you can see how demand goes up a little bit each month. Now, this was a uncharacteristically strong demand push back in February of last year. But this year, you got to remember, we dropped down to 8.0 2 weeks ago. We were 8.3 this week, so the average is 8.22. It ought to be pretty easy to bring demand back close to 7%. So down here, you should start to see demand pop back. This is
what I find interesting about that chart is less that January is slower than December, but January 17 compared to January 12 months prior was down a little bit as well.
Yes, and that's probably, that 400,000 barrel difference probably has to do with just that we're running prices 20-some cents higher at the pump right now to 40 cents higher at the pump. This is a refinery utilization chart. As of Wednesday, we were at 88.2%. As you can see, just 3 weeks ago, at the beginning of the year, or 4 weeks ago, we were at 93.5. And this white line is just one of our technical finders. It's a cycle finder, and it just goes across at the exact same time each year. And you can see that the refinery capacity has a tendency to peak out every year, just right at about the beginning of the year, and then puts a low in also at the fourth quarter. But I do think that you'll see refinery capacity shrink back another 2%, down to that 86% area as we go into February, another week, just because we've got so much gasoline on the market at this time. This is gasoline exports. Interesting here to point out, this is since July of last summer. July through the end of the year, our exports go from 350,000 barrels a day up to 900,000 barrels a day. It's quite a jump in the gasoline supply. A lot of the Central and South American countries have been having some of their own refinery problems. And this time of year, they do like our cheap winter blend gasoline. And they've been continuing to be strong buyers of our gasoline. So as long as they continue to buy our exports, then hopefully we'll be able to drain our oversupply of gasoline soon. Here is an ending stocks chart of gasoline, and of course everybody's concerned about gasoline stocks being up here at a very high level to start the year. Here's where we were last year in 2016. This peak did not occur till like the second week of February, and of course you can see our peak stocks always want to occur just right after the first of the year. But as our demand has been increasing, exports have been increasing, so has our ending stocks. But it hasn't changed our, it's keeping, even though our stocks are higher, let me put it this way, it hasn't increased in a bad way of days of supply. We're using it pretty darn fast. We can use it pretty darn fast. Retail prices, because the market has been dropping, I should say, or stocks have been building, and the futures price has been coming down. It's also bringing down the retail gasoline price. We're down 23 consecutive days now, so that's been very good. And of course, here on the news, you can see that gasoline demand was down 7.7%. That was the week prior to this, and we're down not quite 20%, but it's been 18.5% from the summer peak to this winter low, which was last week at that 8 million barrels a day. And I'd like to point out to everyone that normally you will see demand shift just a little over 10% every year from summer high to the winter low and the winter low to the summer high. This year you're seeing it fall off 18%. So you do expect a pretty good snapback in the next several weeks to several months. I'd like to take this chart, point this out to everyone that's in the retail gasoline business. The black line is the futures market. And as the futures market goes up, retail margins always have a tendency to get pinched. They shrink. They just never can keep up as fast on the street as what the futures market tends to go up. And you can see as the futures market comes down, retail margins have a tendency to go up. And of course, we're clear over here to the right side at the moment. Futures market's been coming down since the tail end of the year, 1st of January. Look at your retail margins, how they've come back up. Currently, from Opus last night, retail margins nationally are running about 21 cents a gallon. So what will happen is when we bottom this futures market out, which we feel is going to happen in the next week, then you'll start to see retail margins get pinched again and probably come back down into this 15 to 17 cent range. Real quick, I also thought I'd show you, this is a comparison of gasoline, retail gasoline prices on February, going into the seasonal peak into that summer time frame. But since we're here at February 3rd, I thought I'd take something as close to this date as possible and show you what the retail price was. The low on 2016 was back on February 15th last year. That retail price was $1.83.5. We rallied into June. National retail average $2.49. It rallied 66 cents. So these are retail price increases. And then over here we have the futures market. And you can see that I used this same date of February 4th. Our exit date I used as the 29th of March, and then here's what our rally was: 21, 4 cents, 14, penny and a half, 25, 42, and this is dollars per contract in a 42,000 gallon contract. And then of course our computer can easily pull out any information you want and show you even what the best date was or the highest date, which was in March. Kind of compares with some of these dates over here, but I didn't run it past March, so then it doesn't keep up with some of the June highs that you're looking at. But it does go to show you that gasoline prices will probably continue to increase from here. Point out real quick, in the futures market, has a very strong seasonal tendency to put a low in this November, December time frame. Clear back from 2000, there's only been a couple of times you've actually gone past December and put lows in that Jan-Feb time period, and 2 of them have been the last 2 years. This year we did bottom in 2016 in the fall of November, and it was November 14th, and we've been rallying since. We actually rallied 40 cents from that OPEC low in gasoline, and we've corrected back about 20 cents now. So the market has made its correction, and most likely it'll start another seasonal rally up into that March-April time frame. But this is the seasonal patterns of gasoline from that fourth quarter to that second quarter high. The average over the last 17 years has been about 70%. So retail store guys, this is something you need to know. Using this kind of information to create your hedge and work on gasoline purchases, as well as knowing how to protect your margins, is something you need to look at. Just also to point out, retail prices versus gasoline futures. The futures market and retail gasoline price does have a 98% correlation since 2013. I wanted to point that out because a lot of times people come back to me and say, well, my retail price doesn't follow the futures market. Well, what we see in a national retail price versus futures is there's a 98% correlation. Real quick, you can see some of you that do read my commentary, I'm always talking about the Chicago market. Here you can see this Midwest market has had the biggest gains, from 50 cents to 65 cents higher than this time last year on retail prices. So the Midwest right now has been struggling. We're 50 to 65 cents higher than this time last year. Right here is where we're at today on the April futures. And here we are. This is February 2nd. I did this chart yesterday. Here is last year's April futures. It did come on down into February 9th, and then it took off and made a rally from there. We feel that this market's going to put a low in here. Either it did today and we'll rally out from here, or we'll see a little low yet in the next 1 to 2 weeks, and then we'll rally on into this end of March time frame. The average date for this low, though, in February on an April futures, you can see is in this February 4th to 9th, and it never didn't come back down and make a low after February 2nd, these 2 days. So the market does show considerable strength. Last chart really to show you, I will have one other chart after this one, but this is a 480-minute chart of gasoline, and you can see here we are at December 31st to January 1st, and the market's been in a sideways to lower channel, and the March futures is finding support here against this 152 to 153 area. And once you get your breakout close above this downward trend line, then we look for the market to make another advance up. But here is your November 14th low in this 132 area, and you can see we rallied all the way up to 172.50. That was your 50 or your 40-cent rally, and now we've corrected at about 50%. So it wouldn't surprise us to see another leg up. And then everybody continues to ask, what will electric cars have an effect on gasoline demand as we go into the future? As it is right now, folks, that's going to be a really tough one to talk about. Citibank even had an article out yesterday that they thought maybe by 2025 electric cars could displace maybe 2 million barrels a day of oil demand around the world. But there's really not too much to worry about at this time. The reason being is because you're going to have to replace, you just don't have the electricity capacity to handle too many cars, and then they're going to have to all be plugged in off-peak hours, and over time you're going to have to also build more electricity plants. And the only place that can really build those kind of plants very quickly, if you really wanted a lot of electric cars, would be the United States. If you go anywhere else around the world, they don't have the infrastructure. China's got rolling blackouts. Asia's got rolling blackouts. They can't even hardly supply a lot of their own electrical needs. So to see the rest of the world try and get onto the electric car market, unless they develop a battery that can last for 30 days at a time and go quite far, it's going to be quite some time before we're able to see electric cars really displace a lot of gasoline demand. And that's the end of my presentation, Jed.
Well, thanks, Darren. Really appreciate that high-level view. I know you spend a lot of time as a trader trying to figure out where energy markets are going. My takeaway or sense was you see the risk to the upside in terms of gasoline and crude prices going forward, more so than to the downside. But I know your mantra as a trader is, if you got exposure, try to hedge that exposure, because none of us can really predict where things are going. But good information. Thanks so much, Aaron. I'll make these slides available to our listeners, and for now we'll move on to Richard Brown and EMV. So, Richard, I'm going to hand the controls over to you, and we'll try to pick up some other questions as we go.
Okay, thanks, Jed, and good afternoon, everybody. Thanks for joining us. As Jed mentioned, I'm Richard Brown, Vice President of Marketing at Patriot Capital. So what I want to do is just take a few minutes today and share some perspective on the Visa announcement back in December of the decision to move the EMV deadline at the pump out to 2020. Here are the considerations that I think are important as the data shifted, and some things you may want to think about for your sites and your dealer sites in terms of, should you encourage them to move now, like your original plan was probably to get them to move in 2017? Should you wait until 2020, or is there somewhere in the middle ground that is the way to approach it? For the purposes of our discussion today, I'm going to assume everybody is familiar with the history of EMV. I'm not going to go too deep in there, other than that the last significant shift was the shift by Visa to move the forecourt liability date out to 2020. The in-store date is still 2015, so that's come, and most of the networks are shifting the liability down either at the end of 2016 or through the first half of 2017. You see that liability coming to you and to your dealers. So that's the landscape now. It's important to realize that the announcements on EMV now are almost 7 years old. They were back in 2011 and 2012. So my take is, from the card brand's perspective, they've given us lots of time to move. So we'll talk about a couple of things. The first is what's going to happen with your consumers. And I think to be informed on that, it's important to look at what happened in the other markets that have moved. Europe and Canada are basically 100% EMV right now. Talking to Bruce Allen, who's the president of Canadian Tire, which is one of the largest retailers of fuel in Canada, he said he definitely saw a share shift across his sites and across his competition as people added EMV. So, and what we're seeing in the U.S. is now people are becoming familiar with EMV inside, and our perspective is as they see it outside, consumers will start to look for it. Some other benefits of EMV-enabled sites: odds are you're going to have TV at the pump and that type of entertaining and marketing out there as you upgrade the pumps. Most of the pumps, majority, have TV on them now. And then secondly, as the brand upgrades go out, you've got upgraded LEDs, which also help to enhance the security on the site combined with EMV inside. So consumers will be able to tell that an upgraded site exists down the street from yours if you haven't upgraded, and that may drive some preference. Behind that is the fact that about 2/3 of Americans are seriously concerned about their credit details and identity theft, and we believe that will drive their behavior going to secure sites. And then lastly, that consumers will easily be able to tell an EMV site from a non-EMV site. You know, in the past with PCI, you wouldn't know if you were at a PCI compliant site or not, but with EMV, it's very easy to tell if the site you're at is EMV compliant by the difference in the transaction.
Richard, and that's just because when I show up and I stick my card in, I know I've got to stick it in and have the chip read, and then I develop that reputation as a site over time of being chip and PIN compliant. Is that right?
Right, correct. So your card is locked in the dispenser during the transaction, just like it is in a retail site. And so as your card goes in and is locked versus the dip we use now, it's fairly obvious that it is a different transaction type. Yeah. And people are going to be very used to using that inside the store. So thank you. Good question. So I think, the way I think about this is at least a third of your customers are security conscious. If I was able to do a quick poll of the folks on the webinar, I think we'd see that well over half of them, either you or your spouse or someone in your family has had your credit card hacked at least once. I've been hacked twice in the last year. So I think consumers are aware of the issue and are security conscious. But for discussion, let's just say that 30% of your customers are security conscious, and let's say just half of them choose for a different site. That would drive you to a potential 15% loss of business at your site, and that would impact both your fuel sales and your inside sales. So I think that's an important consideration, is where your consumer is going to go. I think the second thing that's worth talking about is, sorry, go ahead, Jay.
Richard, and maybe this is where you're going here, but my business would only be at risk if I'm non-EMV compliant if my customers had some of my competitors nearby who were EMV compliant. Do we have a feel for the size of the market given the delay in this liability shift? How many of our competitors are likely already EMV compliant?
Yeah, yes. And let me give me about 2 minutes, and I will come to some hard data on where we are and how that's going to play out.
Okay.
So, thanks. So your consumers are going to seek out EMV sites. At the same time, criminals have got to eat, and I think what we see is the criminal behavior continue. There was an article on Bloomberg yesterday talking about the increase in online card theft and card fraud as EMV is deployed into retail. I think we'll see the same thing on our sites, which is as criminals that have been committing EMV inside realize there's nowhere to go there, they will start looking at the pump. One way to think about that is back in the 90s, the criminals had about 36 million payment points around the world, which is what's shown in the bullseye graphic there on the right. As EMV was deployed around the world, that went down to about 5 million. After 2015, 2016, as we went to EMV inside, that number falls to about 168,000. And now our best estimate is probably about half of our sites will have EMV and half won't by 2019, early 2019 or late 2018. And that's where the criminals are going to go. They aren't going to get honest and get new jobs, as the quote says on the left there from CNBC. So I think it's important to think about, is your site going to be a target for fraud? And if it is, it's going to be your brand. If your whichever brand, Shell, Exxon, BP, in a market, and a BP site is hacked in that market, the headlines are going to be BP, not Mr. Smith or Mr. Patel's convenience store at 5th and Main. So I think there's a broader impact to you than just the one site in a market, but potential damage to your brand across a market. So in terms of where we're headed, I believe a second date shift is highly unlikely. Every other global market of note is converted, and the ATM date hasn't shifted, and the retail date is definitely not going to shift. The chart shows the expansion of acceptance of EMV inside. and we've gone from about 800,000 to 1.8 million retail sites that are accepting EMV now, and that's going to continue to grow. There's a large number that are going to come on board in the first quarter of 2017 as well. So that supports that there won't be another date shift. 2020 is real. And the second thing, and the data here goes to Jed's question of where are we on adoption on the pumps. You've got to bear in mind that all the pumps that have shipped for the last several years are EMV ready. They may need a software upgrade or a small upgrade to the card reader, but pretty well they're ready. And a lot of marketers have invested in getting the networks up to speed. So the best estimates we see are that somewhere at the end of this year, 45%, and the end of next year, somewhere in the high 50s percentage of pumps will be able to accept EMV. So the odds are, to Jed's question, if you're not accepting EMV, the site across the corner or down the street will be. And so from a consumer's point of view, the switching costs aren't that high. It's easy for me to drive a half block, as everybody on the call knows, to go to another site if it gives me the experience I want. Kind of another perspective on where we are with EMV coming online, and this where Gabarco is with Passport. The other software guys are in a similar situation in terms of releasing their point of sale to pump communication and pump upgrades. And the bottom line from this chart, they were all challenged and charging for October 2017. And as you can see here, most of the major payment networks will be converted, at least for Passport, this year or early next year in 2018. So I think if you take this data combined with the installed base of pumps that is out there, odds are if you're not accepting EMV at the end of 2018, your neighbor is going to be. So another thing to think about is, can I save that money? Is it going to be cheaper for me or more expensive if I wait until 2019 or 2020? Some of the factors I would think about, firstly, is our normal inflation in the industry. The pump manufacturers are pretty good about annual price increases. A lot of discussion and I think valid about technician availability and capacity. A lot of our pump technicians are getting older, and the supply of new technicians is pretty tight. I'm sure you see that in your business across all the trades. That's no secret that the Fed's going to move interest rates up probably 100 basis points over the next year and a half. So you've got core inflation in our industry specifically. The second thing is if you take advantage of bonus depreciation, which in this year will be 50% up to $2 million. That's going to decline in 2018, and 2019 it'll be 30%, and then 0% in 2020, and that's with the current Tax Act. If the Tax Act changes, it's likely some of these things will be taken away in exchange for a lower base tax rate. I'll come back and talk a little bit about the impact of that on our business. Two other things to think about. One is that inflation across all categories is anticipated to increase over the next couple of years. So beyond the hardcore costs in our industry, we're going to see things become more expensive. And then if we do see a change to the tax code, that will result in some impact on your depreciation benefits. What I mean by that, if you look at the chart, in today's scenario, if you're to spend $100,000, assume your tax rate is 35%, you get 35% depreciation value. And then whether you take that over 7 years, which would be normal for a pump, so you get about $5,000 of tax benefit a year for 7 years, or if you take Section 179, you take it all in the first year to help your cash flow out, you get that $35,000 benefit today. If the tax rate falls to 15% for your business, the value of that deduction effectively goes from $35,000 down to $15,000. Or said another way, the pump or equipment you're buying costs you about 20% more. So on an annual deduction basis, that deduction would fall from $5,000 down to about $2,000, and there's no telling if Section 179 would stay in place or not. And again, my personal perspective is that if we get some changes to significantly lower the corporate tax rate, some of these other incentives will go away, such as Section 179 and bonus depreciation. So as a result of that, your equipment cost could be significantly more on a net cash flow after tax basis. I'd encourage you to talk to your accountant about this. I'm not an accountant, and your accountant may have a different perspective, but I think it's worth a conversation with your accountant. So the other thing to think about is there additional liability now to your business? A couple of factors come into play on this. Firstly, the Conexus estimate that they published in October is that non-EMV store liability is going to rise from about $5,000 to $30,000. And that's back to the bullseyes. The fraud comes to the non-EMV sites. That the liability on those sites is going to increase significantly. Additionally, you will be liable for fraud on international EMV cards starting this October. So if you're in a heavy tourist area like Orlando or along one of the borders where zip code verification doesn't work, you're going to see some chargebacks starting in fourth quarter of this year. So that was part of the give and take that Visa did with their announcement. And the last point on this to consider is that there will be chargebacks for high fraud locations. So I encourage you to get with your processors, understand which sites in your network they consider high fraud. Visa has some guidelines on what that is. But in general, the estimates are that's 10 to 20% of convenience stores out there. So those sites you are going to have to take some steps to upgrade and reduce the level of fraud on the sites now. So that may mean upgrading the pumps. That may mean putting some additional security procedures in place if you don't have them. But understand that to avoid those chargebacks. So to kind of wrap it up, our perspective is fairly straightforward, which is if your sites are not upgraded, you're going to attract the criminals. If you do upgrade and provide the increased security and the enhanced customer experience that an upgraded site with new pumps, upgraded lighting and things can provide, customers are going to come to you. So criminals are going to the non-upgraded sites, consumers are coming to the upgraded sites. And just a last thing, if you're interested, we've developed this checklist, which we think is a good tool to use with your dealers and with your sales reps to talk through which sites are candidates for an early upgrade and which sites it makes sense to wait and upgrade at a later date. Just a quick series of questions to help you formulate your strategy. I think it's important that each business has a strategy. You may not agree with all of my points, but I think as a management team at your organization, if you kind of review all the things to think about and then put your plan in place, you can ensure you maximize your benefits over the next 4 years. So thank you very much, and take any questions if there are any now. Thank you.
Yeah, Richard, one question I have. So, I mean, you kind of gave a lot of reasons why one would, consider upgrading even though the date has been pushed off to 2020. What are some of the key reasons why people would still decide not to upgrade? Obviously, the cost is foremost in that. Are there other reasons?
Yeah, I think if you're in a market where you know the majority of your customers, it's maybe not a high fraud area. There's some markets that are definitely very high exposure in terms of skimming and other types of fraud. So if I was in one of those markets, I would definitely look at upgrading. If I was in another market, maybe a smaller community, it may not make sense to upgrade. If I had very small gasoline volumes, the return may not be there. But generally people would agree that as you upgrade pumps, you see a lift both inside and outside. So you got to go through the mechanics of what kind of lift would I get, how much business can I afford to lose if people go down the street, and maybe what's my ownership timeline. Do I intend to flip some of these sites in a couple of years, or am I a long-term owner that so I can reap the advantages of the upgrade full cycle?
Makes sense. Yeah. Another concern I've heard expressed is, hey, I can switch today, but technology is likely going to change by 2020. The retrofit kits of today may not meet the encryption ability and so forth of what's necessary in 2020. Can you speak to that concern at all?
Yeah, sure. I think the biggest thing we see on the payment horizon is contactless payments. So whether it's Apple Pay or Android Pay or Samsung Pay, using your phone to tap and go. To use any of those payment methodologies, you need the EMV encryption and technology that goes into EMV. So you cannot implement an Apple Pay or Google Pay without having the hardware upgraded. And so you can't skip and say, well, I'm just going to wait and go to contactless payment. You need the hardware upgrade to be able to facilitate those types of payments. There's no other payment technology I'm aware of that's on the horizon behind EMV. There's talk of tokenization and some different things, but nothing that is near term. And so, and given the time it would take to deploy, I think it's highly likely that we're going to have EMV at the pump and inside for at least 15 years.
And Richard, you kind of said, hey, 2020 is going to be the real date. This thing's not going to get kicked down the road anymore. What was the official reason for 2017 ultimately being delayed?
It was the state of the upgrades. So the Visa and MasterCard said they realized that the industry would not be done by 2017. The pump industry would not be done by 2017, and so they wanted to give it a longer horizon. What's interesting, in other markets, I know in Canada they shifted the date once, but they did put a requirement out that you had to do so much of your network each year. So if they moved the date out 3 years, you had to commit to and show proof that you upgraded your network a third. They didn't do that here for some reason.
And then one more question that came in here. How will the newfound way of EMV card skimming in Canada, the quote-unquote shimmers, affect the rollout?
I'm not familiar with that. Yeah, I'm sorry. I'm not familiar with that enough to give an intelligent answer.
Got it.
My guess would be if there is a way to defeat it, it's a global issue. So both the card companies and the payment companies will be working to resolve that. And I don't know if it'll be a software upgrade or hardware upgrade because I don't understand the problem. But I would suspect it would be a situation where it's an and, that it's a software upgrade or something to the hardware, and they won't relax the pressure to get the hardware upgraded.
Got it. Well, we're right on the hour here. Richard, I appreciate your time. There may be some folks who didn't get questions answered, but I'll be able to see those, and we'll be able to follow up with you kind of one-on-one with those specific questions. So appreciate everybody's time on the call, and for Darren and Richard for educating us here a little bit. Hope you guys found this valuable, and wish you a good day. Goodbye.
Thank you.
Thank you. Thank you.